are back. A lot can happen in 2 minutes. Just before we went on a break, the NSE turnover was 103 million shillings for the day. Right now, the market has closed 180 million, has actually ended up being traded in the last couple of minutes. We'll give you an overview of what happens, or rather what key stock trades happened over the last few minutes. We are today with Elizabeth Wangeshi, who's the head of research at NIC Capital. Elizabeth, you have a very interesting report on the Kenyan banks, and you did a sector update ahead of the first half numbers.
Yes.
What are your valuations? What are the key themes that are coming out from your evaluation? And
thank you for hosting me. So we looked at the banking sector and we covered the tier 1 banks, and we looked at KCB, Equity and Cooperative Bank. So on the main key themes that are coming across is the cost to income ratio is not really changing much from where it was in 2018. The NPLs will still continue going up. That's the second thing. The net interest margin, there's a certain twist now because we've seen now banks starting to lend to the private sector. So other than that, we have a very good recommendation. The prices have been coming off lately. So we have a buy recommendation on KCB and Cooperative, and a hold on Equity Bank.
On Equity Bank.
Yes.
I like you saying that cost to income is coming down, net interest margins, there's potential for upside. So what's the average cost to income ratio that you're seeing, and what's driving that down?
The average cost to income across the 3 banks we've covered is about 50%.
50%. Okay.
Yes.
Okay.
Yeah. So most banks have now shifted more to the digital efficiency, reducing their cost. So that's why we are seeing that shift on the cost to income.
Oh wow! So innovation is certainly a good driver for
efficiency. Yes, it definitely
efficiency.
is in this era of the rate cap. So it's very valuable.
So flat outlook on cost. But then you're saying there's possible upside on revenue. What is going to enhance revenue for these banks?
Revenue, we are looking at the non-funded income.
Okay.
We've seen the recent 2 banks, Equity and Stanbic, that have released the half year 2019. And the key focus, even as we continue having discussions with the management, is that the focus is now more on the non-funded income.
What do you mean by non-funded? Fees? Okay.
Fees and commission.
All right.
Also forex income.
Okay.
But the higher percentage on the fees and commission.
Fees and commission.
Yes.
So this is what they charge on the digital platforms, online banking, mobile banking.
Mobile lending.
Mobile lending.
Yes.
Okay.
Yeah.
All right.
Yeah, Elizabeth, just very interesting that you have, it's actually a downside on equity.
Yeah.
The valuation is about 38
38,
and the stock is actually surpassed your TP. What's why you this is bearish view?
Bearish view.
What I mean, you're not even pricing the fact that they're just about to onboard additional assets from Atlas Mara. That valuation, does it factor in those new assets coming on board?
It actually factors in, but if you look at Equity Bank, where the bank is currently trading at the price to book is above the industry average. So the equity story has been investors always attach a premium on the valuation. The fundamentals, even the story that you have on equity, it's quite strong. If you compare it vis-a-vis how KCB is performing on the NPL, they are not badly off. They're still below the industry average. If you look at the cost to income, they're also able to keep it below 50%. Again, they've started lending. We saw the net interest income growing at about 9% in first half of 2019. So the story is still quite good, but now the price is where we have a question.
The market has overvalued the stock.
Yes, the market has overvalued. Yes.
It's too much premium on the price.
Too much premium.
Yeah. But do you think the market is wrong?
No, I wouldn't say the market is wrong. Our market is so dynamic, by the way. Let me talk about, because we saw what happened on Monday when China decided to devalue their currency. So what happened to the global stocks? Everyone was selling off. They came off. So most investors were shifting their money to safer assets like gold, other commodities. What happened to our markets? Local fund managers just put a hold on investing first in the equities market. So what does that mean to our equities market? Even though the fundamental story is good, the pricing is good, people won't still buy it. So
what's a growth story on COP? Because I've seen you have some A significant upside on your
The
target price.
upside.
I don't know, sorry, if I just may interject on equity before we move to Cope Bank.
Yeah.
I like your heading, cheese outside the sandbox. And your thesis is you're saying there is expected weakness largely on asset quality. Can you just help elaborate that?
Yes, so if you look at the asset quality, the average industry NPL is about 12%. And if you look at where the banks are lending, it's mostly on manufacturing, the corporate book mostly, the trade sectors. Even if you look at the data that we normally have on the private sector credit growth, it's mainly focused on the manufacturing, trade, less more on personal. So most banks are putting this claim that the NPLs are still high because there are delays in payment from government contractors, and also the country is also struggling economic-wise. So in terms of NPLs, that's why we are saying it's still a key risk across the banking sector. It's not a one specific thing.
But my final question on equity, now that it announced its numbers and you published your report, was it in line with what you were expecting, or were they off from your estimates?
Yes, it was. Most key line items were in line. For example, I would touch on the non-funded income, where we were expecting about 39 contribution from the NFI.
So 39% of total revenue.
Total revenue. It came to about 41. If you look at the net interest margin, they were also in line because we were expecting net interest margin of about 8. If you look at the cost-to-income ratio, there was not much of a surprise on that side.
What about the profit after tax growth rate?
It was, I wouldn't say it was, very good results. I would say it was just as expected. Not really double-digit. We would have expected.
All right, thank you.
Yeah.
Elizabeth, this story of NIMs, I mean, in a capped environment, what drives NIMs? Is it the funding costs, or is it the currency mix? Where are you seeing the key drivers of NIMs over the last 3 years? Because obviously it's not asset pricing. With asset pricing, well, banks have been buying treasury bonds and treasury bonds, but also we've seen the yields softening a bit. So what's key driver of NIMs now, especially on the loan side?
Mostly it's on the loan side. We saw what happened when Equity decided to stop lending to the private sector. So what happened to the NIMs? They were favored because of the yields on the government securities. But the current situation is the yields are coming off lower every single day. The rates are off. So what's really supporting that? So now that shift now to the other side of lending now to the to private sector. So now that's what is trying to help and to support the NIM. So in terms of that, we don't expect to see any surprise unless now the rate cap comes on board.
Fine. And let's get back to Cope. I mean, I was asking you, you have a very strong upside in Cooperative Bank.
Yes.
It would be interesting for us to know what's a growth story on this bank.
Actually,
I mean, you say it's an NFI story, it's a non-funded income story.
Yes. I would say more of an NFI, because if you look at the margins and the loan book
expansion. NFI non-funded
income, non-interest revenue.
So this is from fees and transactions and mobile and digital platforms.
Yes, we saw a bit of growth in the last year performance, and the focus right now is still more on the fees and commission. But if you look at the top, the net interest margin, they are not able to grow their loan book at a faster growth like the other banks. So in 2019, we're expecting about an average of about 3%. If it goes higher, maybe say 6% in terms of lending. So I would say their story is a bit different. Where we have a bit of upside on the price, investors have really been pushing the price lower. If you look at the year to date,
What's the YTD performance with actually? I think it's super negative.
Yeah, it's very negative. So even though our upside is really good, it just shows that in the past 6 months or so, investors have really been selling off the company, and that means the price has also been coming off. The story is just an okay story. You can't compare it to what KCB is doing on the NFI and also on what they're doing on the loan book growth, but their story now is more on the price. There's still some positive upside on it.
Let's talk KCB. And obviously, let's kick it off with the news that obviously your valuation here, you have 31%, 30.99% upside.
Yes.
Maybe for our graphics team could just help us put up graph number 10. It just shows an overview of your valuation.
It's actually graph number 9.
Oh,
yeah, and it's number 9. So so the current price is around 40 shillings. Between 40 shillings. Your target price of about 51.7 shillings on that valuation. But let's kick it off with the latest news that we discussed this briefly here. That Parliament, the Finance Committee, has actually issued an objection to the acquisition of the National Bank of Kenya. Does this affect the valuations?
It actually slightly affects our valuation, but remember the value NBK was bringing on board to KCB, it was really minimal.
Yeah.
If you look at the dilution that you were estimating when you were doing this,
it's quite high.
Okay.
Yeah, but what I was talking about is when you look at what the value NBK is bringing to
the
assets, the NPLs, the cost to income also. And also the value of business. It's not really quite significant.
Okay.
It actually looked like it was more, we are actually helping NBK to come on board so that they don't collapse. If you look at how their NPLs are, they're over 90%.
Yeah.
Right? So what would that mean to when they're consolidated to KCBs? It would actually push it above 10%.
Yeah.
Yeah. Once the consolidated numbers come in. Also, if you look at the cost, KCB has managed to keep their cost to income lower than 50%. If they bring on board NBK, there will be that rise in the CTI to even levels of like 55%.
What is the current cost to income ratio?
It's about 50.6. We're expecting about 51 in 2019.
But if a national bank comes on board, that pushes it to 55%.
Yeah, 55.
So it sounds, Elizabeth, that if actually this transaction goes ahead, there could be more pain for KCB if you're a KCB shareholder than there could actually be value.
Yes, there's value for KCB shareholders, and also if you look at the reasons why the committee has given why they don't want the offer to go on board is because of the valuation.
Yeah, the valuation.
It was very discounted.
Yeah.
But there was no other better price. There was no other competitor coming on board. So the question is, if KCB doesn't go forward with this transaction, what happens to NBK in terms of capital? How will they be able to raise their capital?
Yeah. But then the KCB shareholder remains okay.
Yeah.
All right.
Yeah, KCB shareholders still remain okay. The strategy is still okay. It's quite perfect. So, but National Bank, what happens to National Bank?
So this is actually their only. This is the only lifeline that's left for.
This is the only thing
for National Bank. Okay.
Yeah.
But Elizabeth, I mean, two banks have released their Q2 results. That's today we had Stanbic releasing Q2 results. We had Equity Bank released last week. There's something very interesting. These two banks, they all had the cost of funding, balance sheet funding cost up. Equity Bank's balance sheet funding cost up 16%, which is very, very significant. Quarter on quarter, Stanbic's funding cost were up 15% quarter on quarter. Was there a problem in Q2 in terms of funding? I thought the Q2 was a general low interest rate environment in Q2.
It was a low interest environment, but look at also how they're growing their deposits.
Yeah.
If you look at Stanbic and also equities, it's still quite high, and these are very cheap deposits. So what does that mean to the cost of funding?
Yeah.
So it definitely goes higher. If you look at KCBs, for example, it's been at a level of 3.3.
Yeah. That's the weighted average cost of the funding.
Yes. So I would say it's a play on both sides. They're able to mobilize more deposits, and they're also growing their loan book at a faster pace.
Elizabeth, I must ask you this question. As always, I always ask you when you come here. So yesterday, the second reading, or rather it was scheduled for yesterday in parliamentary proceedings with regards to the finance bill and the rate cut. When you're doing your own scenario analysis, are you looking at your net interest margin evolution if the interest rate cap is actually repealed or adjusted? Does that play in your mind ever? It
does actually play in our minds when you're doing that.
All right.
But when we listen to debates across and what's happening with the rate cap story, the probability is quite low.
It's very low.
It's very low. And if the probability of repealing it or changing or modifying it in general, it won't make much of a difference to what you're having currently.
Okay.
Yeah, so it's quite debatable, even if you do scenarios of whether the interest rate will be repealed or whether the modification will be. It's still, the details are very scanty. You can't really put that in a model and say 1, 2, 3, because also from the debates it's also not understandable whether they're also understanding the impact or what they want to bring on board.
Yes. Okay, I asked that because I like that you've said the KCB cost of funds is about 3.3%, give or take. And then based on the current law, they can actually extend credit at 14%. So the cost of this credit is 3.3%, which leaves them with a gross margin of about 10.7%. So I'm thinking wildly, if anything happens to that rate cap and it moves up, even to 18%, your gross margin moves from 10
to,
and it can add like 6 percentage points, 8 percentage points, which means it's, in a way, whether it happens or not, it's something that we need to keep tabs on, because it changes the thesis of whether what happens with your banks.
It definitely changes the whole perspective on how you look at it, but also look at it. We wouldn't expect the rates to go all the way to where we are seeing them at levels of 21. If you look at even how government securities and also the bonds, the rates, how the rates have come off.
So I need to tamper down my excitement as an investor.
Yes, definitely.
All right. Elizabeth, what else have we not captured that you think is very important when we're looking at banks, and especially as they're about to start, I mean, as they've already started announcing first half?
And actually, before you answer that, I've just noticed that the cost of equity is very, very high. I mean, for KCBs, it's almost 20%. I mean, these banks are not meeting the cost of equity. Does this apply? Should we be market discounting the valuations based on this? You're not very concerned that they're not returning the cost of equity?
They're not returning the cost of equity. I would say, I think with time, fundamentally, our investors have also not been appreciative of what these banks are doing. But overall, I would say the returns are barely as expected.
Okay. So what else is there?
I think for the banks now is, I would say, just removing the mindset from an interest rate cap repeal, and now focusing on more strategies like what you've seen the top tier 1 banks doing, focusing more on non-funded income. You've seen Stanbic, the contribution now it's still growing with time. Equity, the contribution is now over 41%. KCB is trying to grow the NFI contribution to 32%. So that reduction of non-reliance on the net interest income will definitely be a plus for all the banks across. But then now that takes time for other smaller banks, because they have to incur the cost of digital platforms and all that.
And your top pick is?
My top pick best is, I think, KCB.
KCB with a target of 51.74.
I'm shorting KCB.
All right, there you have it. So the banking sector looking very interesting. Best top pick, KCB at 51.74 target price. That was Elizabeth Wangeshi speaking to us from NIC Securities. Look out for us again tomorrow, same time, 2:30. And just in case you missed this, you can always catch us on YouTube Metropole TV channel. Have a good afternoon.